RSI explained, the one rule most traders get wrong. RSI above 70 means sell. That's the rule everyone learns first. You see it in every trading guide, every beginner's tutorial, every YouTube video about technical analysis, and it's not wrong. It's just incomplete. And that incomplete picture causes traders to misread charts every single day. Here's the thing, RSI is one of the most widely used indicators in the world. If you open any stock chart on any platform, TradingView, Yahoo Finance, your brokerage app, RSI is probably already there, sitting right below the price chart. But most people only know one rule about it. And that one rule, used in isolation, is how you end up selling into a ripping bull market or buying into a falling knife. By the end of this video, you'll understand exactly how RSI works, how to actually interpret what it's telling you, and the 3 mistakes most beginners make that turn a useful tool into a losing habit. Let's get into it. RSI stands for Relative Strength Index. It was developed in 1978 by a technical analyst named J. Wells Wilder Jr., and it's been a standard tool in technical analysis ever since. Here's what RSI actually measures. It's a momentum oscillator. That's a fancy term for a tool that tells you how fast and how far a price has moved in one direction. Specifically, RSI answers this question. Over the past 14 trading days, have there been more up days or more down days, and by how much? It calculates the ratio of average gains to average losses over that 14-day window and converts the result into a number that always falls between 0 and 100. The 14-day period is the most common default. Most charting platforms set it automatically. Some traders use 9-day RSI for a faster, more sensitive reading, or 21-day for a smoother, slower one. But for this video, we'll use the standard 14-day, which is what you'll see on most charts. That's what RSI is. Now let's look at how it actually works on a real chart. Let me walk you through how RSI actually behaves on a real chart. Here's the S&P 500 over the past 12 months. The top half is the price chart. The bottom half is the RSI panel. That's the line that waves between 0 and 100. You don't need to understand the formula to use RSI, but understanding the logic behind it matters. RSI tracks whether buying pressure or selling pressure is winning each day and by how much. When buying wins big, consistently for many days in a row, the RSI rises towards 70 and beyond. When selling dominates, RSI falls toward 30 and below. Think of it like a rubber band. The further RSI moves from the middle, from 50, the more stretched the rubber band becomes. At some point, the stretching slows and often reverses. RSI is measuring that stretch. Now look at the RSI line over this 12-month period. Notice that it doesn't stay at the extremes for long in most cases. During a normal market, RSI oscillates between roughly 40 and 65. The middle range, the 50 level, is the neutral line. Above 50 generally means buying momentum is stronger. Below 50 means selling momentum is dominant. The times when RSI pushes above 70 or drops below 30, those are the moments worth paying attention to. They don't tell you the market is about to reverse. They tell you the market is stretched, and that momentum may be reaching an extreme. That distinction, stretched versus reversing, is exactly what most beginners miss, and it's why RSI alone never tells the full story. Let me show you what those extreme readings actually look like in practice. There are 3 RSI readings you'll see over and over, and each one means something different. Here's the critical thing to understand. RSI above 70 does not mean sell. It means the price has been rising hard and momentum is elevated. In a strong uptrend, like the S&P 500 during a bull run, RSI can stay above 70 for weeks at a time. Selling just because RSI crossed 70 in a strong trend is one of the most common mistakes you'll see. What RSI above 70 actually signals is, pay attention. Watch whether momentum is holding or starting to fade. If price keeps climbing but RSI starts rolling over, that's the warning sign, not the 70 line itself. This is the mirror image. RSI below 30 means selling pressure has been extreme. Again, it doesn't mean buy here. In a hard downtrend, RSI can stay below 30 for an extended period. But when RSI drops below 30 and then starts curling back up, that often marks a zone where selling exhaustion is beginning. The third signal, and arguably the most powerful, is divergence. Divergence happens when price and RSI move in opposite directions. For example, price makes a new high, but RSI on that same move makes a lower high than the previous peak. That's called bearish divergence, and it tells you that even though price went higher, the momentum behind that move was weaker than the last one. That kind of signal often precedes a slowdown or reversal. Not always, but frequently enough that experienced traders treat it as a serious warning. It's the kind of detail that isn't visible in the price chart alone. Keep an eye on divergence whenever you're looking at an extended trend. Let me walk through the 3 mistakes I see beginners make with RSI, because knowing these will save you from a lot of confusion. If you sell every time RSI crosses above 70, you will constantly exit strong trends early. RSI is a momentum indicator, not a sell signal. In a trending market, overbought conditions can persist for a long time. The right move is to use RSI as context, not as a trigger. RSI doesn't know whether the market is in a bull trend or a bear trend. A reading of 55 means something very different in an uptrend versus a downtrend. Always pair RSI with at least one additional reference, whether that's a moving average, a support level, or the broader trend direction. RSI alone gives you half a picture. A 14-day RSI on a daily chart is measuring 14 days of momentum. If you're looking at a 5-minute chart, the same RSI is measuring 14 5-minute candles, about 70 minutes of price action. That's a completely different signal. The time frame of your chart must match the time frame of your analysis. Most beginners don't think about this until they've already been burned by it. RSI is most reliable on daily and weekly charts. Use it there first. Let's bring this together. 3 things to remember about RSI. 1. RSI is a momentum indicator. It measures how fast and how far price has moved, on a scale from 0 to 100. Above 70 is overbought territory. Below 30 is oversold. 2. The most important signal isn't the 70 or 30 level, it's divergence, when price moves one way and RSI moves the other. That tells you momentum is weakening before the price confirms it. 3. RSI is context, not a trigger. Always pair it with trend direction and price levels. Never trade RSI in isolation. If you found this breakdown useful, drop a comment below. Which indicator should we cover next? MACD Bollinger Bands? Moving averages? Let me know what you want to understand better, and I'll build the next video around it. If you're not subscribed yet, hit that button. We put out this kind of breakdown every week. This video is for educational purposes only and is not investment advice. Always do your own research and consult a licensed financial professional before making any investment decisions. See you in the next one.